Howdy, Jacob here. Today we're looking at Fresenius Medical Care Corporation, ticker symbol FMS, in the healthcare providers and services industry. Don't like to see this return on invested capital consistently going down really since 2005. I don't like to see the enterprise value a little bit above market cap, about $5 billion or 30+% of the market cap. But revenue growth growing a 2 to 5% a year for the last 10 years. Couple years of negative growth, but outside of that, somewhat consistent in that a little bit more in inflation range. Return on invested capital in the low single digits, mid single digits, and I don't like that bottom line is decreasing when revenue is going up. I'd like to see companies being more efficient with the dollars coming in, and we're just not seeing that. So R&D is going to be about 1.5% of revenue, and majority of their cost is cost of goods sold, so the products to create what they sell. $1.6 billion, $1.7 billion in cash and cash equivalents, with $1 billion short-term debt, $7.7 billion long-term debt. It is looking pretty consistent over the last 10 years, so not like they're just heavily utilizing debt to grow, which they didn't have a lot of growth in the first place, but it's still good to see. But still, that's a debt that is going to need to be paid off at some point, or at least managed. And so that $7 billion is a little bit of free cash flow, not so much that it's horrendously concerning, but you are looking at maybe 4 years of free cash flow to pay that off. It's under 5, so that's, less than horrible, but I definitely prefer less than 3, because then that gives you opportunities to, if you do need to increase your debt to finance a very massive return on investment opportunity, you can still do so. Can you do so when your debt is a little over 4 times your free cash flow? I mean, yes, still, but then you get to more dangerous levels that I'm not necessarily attracted to. But alas, they've been buying down debt pretty consistently. They have a dividend that is a 2.5% yield and digs into about a little less than 20% of free cash flow. And acquisitions is another form of capital allocation that they utilize. Haven't bought back shares since 2019, 2020. So definitely majority debt reduction, a little bit less than 20% to dividends, and then some acquisitions. So let's make some assumptions given all that. Revenue growth, probably not looking at anything super attractive. Let's go with 4%. Margins, I love that free cash flow is a bit higher. Maybe let's do 7 and 8%, but that is going down. Maybe it's 6 and 7%. Change of shares, 0. Terminal P, let's do market average here. A little less, actually, given the debt that they have. And then the dividend, have they increased that recently? No. So let's keep that where it's at the next 7 years. I'm going to decrease this P a little bit more, because again, we're seeing that enterprise value is about 30+% greater than market cap. So that is going to be, I do like to take debt into consideration when I think about these terminal values. And so even with a little bit of money going to debt reduction, some to their dividend and acquisitions, they're still going to have a little bit of debt at the end of the 7 years. So that's why that P and price free cash flow is down below the 15 or 16 market average. So even with this, it needs to fall 31%. Again, not terribly far off. Interesting business, doesn't look super sexy, so I definitely want to get a good return. Very likely positive return on this investment and get it at a cheaper price. I hope you enjoy this video and have a great day. Thanks.